This lecture is presented by John Moffat of Open Tuition. For other free lectures, visit opentuition.com.
All right, we've done the first 10. Let's carry on with number 11. Which of the following statements is correct? Yet again, it's so important. I tried to stress in our lectures that not only can you do the arithmetic, the calculations, and there's certainly more calculations when we come to section B, but 50% of the exam overall is testing understanding, what I always call the written side. And you can see so many of these multiple choice questions don't involve arithmetic at all. Anyway, back to where I was. Which of the following statements are correct? Number 1, capital market securities are assets for the seller, but liabilities for the buyer. No. You buy a security, so it's an asset for the buyer. It's a liability for the seller. They owe you money, so no. Look at the choices, actually. Yet another one. We know the answer already because 3 of them have 1 in and 1's wrong. Anyway, I'll carry on. Financial markets can be classified into exchange and over-the-counter markets. Yes. Financial markets, there's stock exchanges, the exchange, but also you can buy things over the counter, what you might call almost a private deal. 3, a secondary market is where securities are bought and sold by investors. Yes, it's called a secondary market. I own securities in a business. I sell them to you. That's the secondary market. So it's 2 and 3. The answer is C. 12. Which of the following statements are correct? A certificate of deposit is a money market instrument. Yes. You know, it's reading the notes. They're all listed, different types of money market instruments. 2, money market deposits are short-term loans within organisations such as banks. Yes. Oh, I'm a tiny bit. The examiner said yes. I'm a tiny bit unhappy with this. Individuals, in fact, can have money market deposits. They use the same name, meaning slightly different things. However, I'm sorry, the examiner regarded that as being true. 3, no question. Treasury bills are bought and sold on a discount basis. Yes. So all 3 are true. The answer is D. 13. A calculation. A company is evaluating an investment project with the following forecast cash flows using discount rates of 15 and 20%. What is the internal rate of return? Well, there should be no question as to how we calculate IRR. That is so standard. It's there. It's somewhere in virtually every exam. This really has to be speed on your calculator. At 15%, I wouldn't write everything down in the exam. I really wouldn't. I'm writing it down here, then you can follow me. Hopefully, 2, 3, 4. But you should be able to do most of it straight on your calculator. But the flow, 6.5, outflow, 2.4, 3.1, 2.1, 1.8. The discount factors at 15%. From the tables, 1 year, 0.87, 0.756, 0.658, 0.572, and so the present values, 2.4 times 0.87, 2.088, 3.1 times 0.756, 1.382, 1.030, and so the net present value at 15. Plus 0.344. I think that's right. Let's redo it at 20. Was it 20% the examiner asked for? Yes, 20%. So the flows again, 6.5, 2.4, 3.1, 2.1, 1.8. The discount factors at 20% are 0.833, 0.694, 0.579, 0.482, giving present values 2.4 times 0.833, 2.0, 1.999 if I keep to 3 decimal places, 1.999, 3.1 times 0.694, 2.151, 2.1 times 0.579, 1.216 times 0.482, 0.868. The net present value is minus 0.266. Thankfully it's lower, otherwise I'd have made a mistake. It must be lower at a higher rate. The internal rate of return, therefore, yet again, look at the lectures if you need. I can't have a full lecture here, it'd be stupid. But it's 15% of the first guess, plus, we need a change of 0.344. The total change between the two, 0.344 plus 0.266, times the difference between the rates of 5%, 20 minus 15, which gives me, if I do the second bit first, 0.344 divided by what does it come to? 610 times 5. So this bit I get to be 2.82 plus 15. I get 17.82%. Is that one of the choices? Yeah, they didn't do one decimal place, so 17.8. The answer is C. Now, all right, that took me a while because I was talking at the same time and writing it all down. But although it's something you should find very easy, internal rate of return has to be automatic. You shouldn't need to stop and think. At the same time, there's quite a lot of arithmetic to do that. You've got to be fast on your calculator. You've got to be, as I say, don't waste time writing everything down. All right, the main thing is to get it right, but you know that there is this time pressure. Since you must have a scientific calculator because of other things that can be asked, it would be as well if you're able to make use of your memory efficiently, the memory on the calculator, and that you could put things in without having to keep writing down each step. Anyway, I'm talking too much. 13, that was C. 14, back to statements. Which of the following statements are correct? Number 1, interest rate options allow the buyer to take advantage of favourable interest rate movements. Yes. If it moves in your favour, you don't use the option, get the benefit. If it moves against you, use the option, which is the right, effectively, to get a fixed rate, a maximum rate. 2, a forward rate agreement does not allow a borrower to benefit from a decrease in interest rates. True. With a forward rate agreement, you've got a fixed interest rate will apply, whether the actual rate turns out to be higher or lower. So even if it's lower, you've got to use the fixed rate. You don't get any benefit. Finally, 3. Borrowers hedging against interest rate increase will buy interest rate futures now and sell them at a future date. Remember, if interest rates go up, futures price will go down. You've got that inverse relationship. So we're worried about interest rates going up. To cancel that extra cost, we need to make a profit on the futures. How can we make a profit if the futures price falls? You sell today and then buy back later at the lower price. So you would sell now and buy later. What did number 3 say? Buy now and sell later. Well, that's wrong. And so it's 1 and 2. The answer, therefore, is A. 15. Bit of arithmetic. According to the Baumol model, what is the optimum amount of short-term investments to convert into cash at each transaction? This is very much just using the formula. He doesn't give the formula in the exam, which is, I don't know, unusual. Normally formulae are given. But remember, it's exactly the same formula as the economic order quantity formula for inventory control. And that formula is given. You see, the economic order, sorry, it's 15. If you're doing inventory control, economic order quantity is the square root of 2 times the total demand times the cost of each order divided by the holding cost. Well, we're not doing inventory control here, but again, it is the same formula. But total demand, instead of being the total units, it's the total amount of cash we need, which in this question, the company needs 150,000. The order cost, well, we're not ordering inventories, but we're ordering cash. We've got, so it's the transaction cost. Converting the short-term investments into cash incurs a fixed cost of 400 per transaction. That's effectively your order cost, 400 each time, divided by, well, the holding cost is the interest, but it's the net interest in that the short-term investments are earning 5%. Take the money out and put it on ordinary deposit, and we only earn 1%. So the cost is the difference. We're losing 4% or 0.04. And so this should be a very quick one. And so you've got the formula, even though it's there as inventory control. A few minutes to read the question, but it shouldn't take long. And then, as always, it's calculator speed. 2 times 150,000 times 400 divide by 0.04 equals 3 with lots and lots of zeros. Take the square root, and I get 54772. Is that there? Yes, it is. The answer is C. Okay, let's carry on. We've just done question 15. Remember, we're doing the June 2015 paper F9 exam. We're in section A, the multiple choice. We've just done 15. Let's do the remaining 5. So, first of all, 16. Which of the following statements is or are correct? Number 1, factoring with recourse provides insurance against bad debts. No, it's learning the terminology. If you look at the lectures on managing receivables where I talk about factoring, if you are factoring without recourse, then the factor suffers any bad debts. We don't suffer any. It is insurance against bad debts. But factoring with recourse, factor collects the money in, but we suffer any bad debts. It doesn't, therefore, provide insurance. So 1 is wrong. What about number 2? The expertise of a factor can increase the efficiency of trade receivables management for a company. Yes, that's one of the reasons why you might employ a factor. They're better, they're more efficient, perhaps, at collecting debts than we are ourselves. So So, a pretty quick one. It's 2 is only, so it's A. 17. An investor plans to exchange $1,000 into euros now, invest the resulting euros for 12 months, and then exchange the euros back into dollars at the end of the 12-month period. The spot exchange rate is 1.415 euros to the dollar, and the euro interest rate is 2% a year. The dollar interest rate is 1.8. Compared to making a dollar investment for 12 months, at what 12-month forward exchange rate will the investor make neither a loss nor a gain? So effectively, they want to know the forward exchange rate, 12 months, and it's on your formula sheet. If I can find my formula sheet. 1 second, I'm sorry. Here we are. No, I've lost it. It's the last formula on the formula sheet, that F0, the forward rate, is S0, the spot rate, times 1 plus IC over 1 plus IB. And so just remember what the symbols are. The forward rate for 12 months is what we're after. And so it's the current spot rate, which is 1.415 euros to the pound, to the dollar, I'm sorry, times, well, if you've watched the lecture, I'll say there how I remember it, which is a bit silly, but it works for me. It's up to you how to learn it. IB, I say RB is the base country, which is the currency we're quoting against. So it's euros 1.415 to the dollar. So I say dollar's the base country, the home country, and the interest rate for the dollar is 1.8% or 0.018. IC on the top is the other country, and the other country was the euro country, and the euro interest rate is 2% or 0.02. And so a quick calculation. 1.415 times 1.02 divided by 1.018 is 1.418. Yep, the answer is C. So they're a very, very quick one. Apart from the statements, it was so far it's the quickest calculation on the paper, provided obviously that you get your interest rates the right way around. Number 18. Which of the following statements are correct? If a capital market is weak form efficient, an investor cannot make abnormal returns by using technical analysis. Yes. Very much a question of reading our notes, your textbook, whatever. But that's yes. Number 2, operational efficiency means that efficient capital markets direct funds to the most productive use. No, operational efficiency is where the capital markets, the stock exchange and so on, are working efficiently. We're buying, the prices are fair because the trading happens efficiently. Number 3, tests for semi-strong form efficiency focus on the speed and accuracy of share price responses to the arrival of new information. Yes. The more efficient the market is, the more share prices will react quickly to new information. In an ideal world, share prices would react instantly. So it's 1 and 3. The answer is B. Nearly there, number 19. What is the after-tax weighted average cost of capital of GFV? Well, the weighted average, the weighting of cost of equity, cost of debt. So here on a market value basis, which is what we always use for the weighting, GFV is financed 70% equity, 30% debt. The after-tax cost of debt is 6%. Before we take a weighting, we also need the cost of equity. And here they haven't told us, but they have told us the beta, the risk-free, the risk premium. So it's capital asset pricing model. It's the risk-free rate 4% plus beta 1.2 times. Now always be careful here. It's times the excess of the market return over the risk-free. If you'd given us the market return, if I'd said the market return was 8% or something, it's 1.2 times 8% minus 4%. But here they haven't. They've told us the risk premium is 5%. And the risk premium, that is the excess of the market over risk-free. It means the market actually would be giving 9. So it's important to read carefully there, the way it's given. However, 1.2 times 5 is 6 plus 4 is 10. The cost of equity, therefore, is 10%. Now we can take a weighted average. Debt is 30% by debt, 70% by equity. Multiply and add up gives us what? 1.87. 8.8% as the weighted average cost. D. Finally, number 20. The following financial information relates to QK company. Before I read, I should have looked at the bottom. On a historic basis, what is the net asset value per share? Well, apart from one, in a moment, obvious potential silly mistake, there really is no excuse. What's the total asset value? The total assets come to 140. The net assets subtract the liabilities, so we've non-current of 20, we've current of 15. So in total, the net assets of the business are 105, which in fact you could have written straight down because that must be equal surely to the total shareholders' funds, share capital plus reserves. To get the net asset value per share, divide by the number of shares. And here's the one silly mistake to watch out for. From the statement, share capital is 25 million. Everything's in millions here. 25 million. But the top line did say the nominal value is 50 cents per share. So if each share is 50 cents and the total nominal value is 25, it means there must be 50 million shares in issue. 50 million shares at 50 cents is a total of 25 million. So there we are, the net asset value per share, 105 divided by 50 is $2.10 per share. The answer is A.